I was just doing some back testing. I thought that it might be beneficial for me to come on here just for my own personal log, just to annotate and to discuss over a market maker sell model. And this was a prime example of a market maker sell model. As we see throughout this day, I believe it is Wednesday, February 8th. We have big expansion in the New York AM session. We have big expansion New York AM session. London, classic London protraction. London accumulates above the midnight opening price. We then get expansion lower. We create the SIBI. We come into here, and then look at this. It might be a little bit messy right now. We come into here. We take all these stacked equal highs. They get made jagged. Then we have displacement lower, and then we come back up. And right now we're within a market maker buy model, but this market maker buy model here is not going to get completed because what are we in? We're in bearish order flow. So therefore, this market maker model is not going to complete. It's just going to come back up to where I didn't even look this far yet, but this is probably a 1 hour gap. Yeah, look, 1 hour fair value gap. And then this also is that new week opening gap here. Price ends up respecting that perfectly. We come up after lunch AM session. We come up and we take buy stops. So we know a lot of traders in the AM session are taking and are a part of this move. So then price gets drawn higher up into this buy side here, up into take out these stops here. There might be some stops trailing here, but I would say most of the stops would be trailing at a swing high like this. And then we know that, or at least I know that this whole move higher was actually just engineering liquidity. We are just engineering liquidity on this whole high. Why? Why does that make sense? In order for us to sell off again and to attack these buyers, we need to engineer that liquidity in some form. On this way up, on this way up, on this way up, we're just engineering liquidity so then we can have an attack on sell stops because we need to have liquidity that we are generating. If we are going into a fair value gap, to then head lower, we need to engineer liquidity on the way higher to that fair value gap to then head lower. So if we just look at this, we have a clear original consolidation. You have your first buy side of the curve here, and you have your second. And look at what price does here. We end up displacing lower. Through this previous distribution phase. So now we know, hey, we're likely in this market maker sell model, but we're not going to push the button yet. We know we have an original consolidation here. But we're going to wait. We want to see more. We have this area that we've left unbalanced here. We have this fair value gap here. We also have this order block that we also could return to. So it's just something that's a little ambiguous. And also what I do want to point out here is I didn't really mention it, but this now becomes your smart money reversal. And I know for a fact that we will have an SMT here. And I can prove that. If we pull up Dow. We have SMT here. We didn't have an SMT with NQ, but we had the SMT with Dow. We end up having displacement lower. We rebalance where? To this fair value gap here. Also into this order block. Where also is this? Probably OTE. I'm not going to draw the levels, but it's at 75%. It's a very deep retracement. It's a very deep retracement on this part of this sell side of the curve. Then we have displacement lower. You could take this entry here. That probably would have been the better entry. After that is confirmed here, we get displacement lower, pull back to order block, pull back to the wick here, to then have here, and then to have that last phase of distribution down to that original sell side of the curve. Right now, smart money takes partials here. They offset some of their orders here. Price gets pushed a little bit higher to still respect this to then head to that original consolidation. And yeah, that was kind of the little market maker model you had. Also, what I do want to point out is here, once we displace through this, or once we are around equilibrium of this implied dealing range here, we're expecting to see some stop hunts, and we get that here. It's not like a clean, pretty stop hunt here. It is a deep retracement. But why is price retracing here? Price is retracing here to rebalance price to this inefficiency right here. To rebalance price to this inefficiency, right now we have this order block, and then we end up heading lower, and then we end up having our three phases here. Your lower risk entry, your first stage, and then your second stage, your silver bullet right here. Price ends up getting delivered here. I'm gonna zoom out. I want to get like just a little perspective of this on the 5 minute because I know it's a little bit too zoomed in. First entry here, 5 minute fair value gap, to then have another 5 minute fair value gap entry here, to then have that 5 minute order block here, and then we end up going down to that nice original consolidation. But yeah, this was a very nice example of London or lunch run on stops to then have or to then have that PM continuation after we get that stop on here. But yeah, I think I might post this video. I'm not 100% sure, but I might as well just post it, and I'll probably do a few of these reviews. These are just for my journal. Like this is just my journal here, and yeah, maybe you could get something out of it, or maybe you can coach me if you see me messing up.